What is cryptocurrency? Cryptocurrency is a type of digital or virtual currency that uses cryptography for security. Unlike traditional currencies issued by governments, like USD, Euro, etc., cryptocurrencies operate on decentralized networks based on blockchain technology. This decentralization means that no central authority, such as a bank, controls the currency, providing more transparency and security. Types of cryptocurrencies. Bitcoin, BTC. The first and most well-known cryptocurrency, created by an unknown person or group of people using the pseudonym Satoshi Nakamoto. Often referred to as digital gold, Bitcoin is used primarily as a store of value and for peer-to-peer transactions. Ethereum, ETH. Developed by Vitalik Buterin, Ethereum goes beyond Bitcoin by allowing developers to build decentralized applications, dApps, on its blockchain. It introduced the concept of smart contracts, which are self-executing contracts where the terms are directly written into lines of code. Stablecoins. Cryptocurrencies designed to minimize price volatility by being pegged to a reserve asset like the US dollar or other traditional currencies. Examples include Tether, USDT, and USD Coin, USDC. How cryptocurrencies work. Blockchain technology. At the heart of most cryptocurrencies is blockchain technology. A blockchain is a distributed ledger that records all transactions across a network of computers. Here's how it works. Decentralization. Instead of being managed by a central authority, the blockchain is maintained by a network of nodes, computers, that validate and record transactions. Immutability. Once a transaction is recorded on the blockchain, it cannot be altered or deleted, ensuring transparency and security. Consensus mechanisms. Different cryptocurrencies use various methods to validate transactions. For example, Bitcoin uses a proof-of-work (POW) mechanism, where miners solve complex mathematical problems to add new blocks to the blockchain. Factors to consider when choosing an exchange. Security. Look for exchanges with robust security measures, such as two-factor authentication, 2FA, cold storage for funds, and regular security audits. Fees. Compare transaction fees, withdrawal fees, and any other charges. Lower fees can significantly impact your trading profits over time. User interface. A user-friendly interface is essential, especially if you're new to cryptocurrency trading. Look for exchanges with intuitive design and easy navigation. Supported cryptocurrencies. Ensure the exchange supports the cryptocurrencies you want to trade. Liquidity. High liquidity means you can buy and sell assets quickly without causing significant price changes. Customer support. Reliable customer support can be invaluable if you encounter any issues. Regulation and compliance. Check if the exchange complies with local regulations and has proper licenses. Reputation. Research the exchange's history, read user reviews, and check for any past security breaches or scams. Popular exchange platforms. Coinbase. Known for its user-friendly interface and strong security measures, Coinbase is a great choice for beginners. Binance offers a wide range of cryptocurrencies and lower fees compared to many other exchanges. It's popular among both beginners and experienced traders. Setting up an account and verifying identity. Sign up. Visit the exchange's website and create an account by providing your email address and creating a password. Verify your identity. Most exchanges require identity verification, KYC/AML, to comply with regulations. This usually involves submitting a copy of your ID and proof of address. Deposit funds. Once your account is verified, you can deposit funds into your exchange account using various methods such as bank transfer, credit card, or other cryptocurrencies. Start trading. After your funds are available, you can start buying and selling cryptocurrencies on the exchange. Understanding different investment strategies. Investing in cryptocurrencies can be approached through various strategies, each with its own benefits and risks. Here's a detailed look at some popular strategies. 1. Buying and holding, HODLing. HODLing is a strategy where investors purchase assets, such as cryptocurrencies, and hold onto them for a long period, regardless of short-term market fluctuations. This approach is predicated on the belief that the asset's value will increase significantly over time. Pros. Simplicity, easy to understand and execute. Lower costs, reduced transaction fees since you're not frequently trading. Long-term gains, potential for substantial returns if the asset appreciates in value. Cons. Patience needed, requires a long-term perspective and strong conviction in the asset's future. Market volatility, exposure to market fluctuations and potential downturns over the holding period. 2. Trading, short-term and long-term. Short-term trading involves buying and selling assets within a short time frame, from minutes to a few days. Traders aim to profit from rapid price movements and trends. Requires a good grasp of technical analysis and market indicators. Pros. Quick profits, potential to make fast returns. Volatility advantage, can take advantage of market volatility. Cons. High risk, frequent fluctuations increase the risk of losses. Time-intensive, requires constant monitoring and quick decision-making. Higher costs, increased transaction fees due to frequent trading. Long-term trading. Similar to hodling but involves holding assets for several months to a few years. Traders aim to profit from longer-term price movements while being more active in managing their positions. Pros. Balanced approach, potential for significant gains with less time commitment compared to short-term trading. Trend benefits, can capitalize on both market trends and individual asset growth. Cons. Regular analysis required, needs ongoing market analysis and periodic adjustments. Exposure to volatility, subject to market volatility over extended periods. 3. Staking and lending, earning passive income. Staking involves holding cryptocurrency in a wallet to support blockchain network operations. Participants earn rewards, usually in the form of additional cryptocurrency, for their contribution. Pros. Passive income, generates income without active trading. Network support, helps secure and maintain the blockchain network. Cons. Fund lockup, requires holding and locking up funds for a certain period. Network risks, potential risks related to the network's performance and security. Lending involves lending your cryptocurrency to others through decentralized finance, DeFi, platforms, or exchanges. Lenders earn interest on their lent assets, providing a steady stream of passive income. Pros. Idle assets, generates income from otherwise idle assets. Flexibility, various lending durations and terms are available. Cons. Default risk, risk of borrower default and platform security issues. Variable rates, interest rates can fluctuate based on market demand. Cryptocurrency security and risk management. 1. Importance of strong passwords and two-factor authentication. Strong passwords. Complexity, use a combination of uppercase and lowercase letters, numbers, and special characters. Avoid using easily guessable information like names or birthdays. Length, aim for a password that is at least 12 characters long. Uniqueness, never reuse passwords across different accounts. Each account should have its own unique password. Password managers, consider using a password manager to generate and store complex passwords securely. Two-factor authentication, 2FA. Added security layer, 2FA requires two forms of identification before granting access, typically a password and a code sent to your mobile device or generated by an app. Methods, common methods include SMS codes, authenticator apps, like Google Authenticator or Authy, and hardware tokens, such as YubiKey. Implementation, enable 2FA on all accounts, especially on cryptocurrency exchanges and wallets, to significantly reduce the risk of unauthorized access. 2. Safeguarding your private keys. Private keys. Definition, a private key is a secret number that allows you to access and manage your cryptocurrency funds. It's crucial for signing transactions and proving ownership. Storage, never share your private keys with anyone. Store them in a secure location. Cold storage, use offline storage methods like hardware wallets, e.g., Ledger, Trezor, or paper wallets to keep your keys safe from online threats. Backups, make multiple backups of your private keys and store them in different secure locations, e.g., safe deposit boxes, secure physical locations. Avoid digital copies, Do not store private keys in digital formats like text files on your computer or cloud storage, as these are vulnerable to hacking. 3. Understanding the inherent volatility of the cryptocurrency market. Market volatility. High volatility. Cryptocurrencies are known for their extreme price volatility, with values fluctuating significantly in short periods. Market sentiment. Prices can be influenced by various factors, including news, market trends, regulatory changes, and technological developments. Risk management. Be prepared for rapid changes in value and consider the following strategies. Diversification. Spread your investments across different assets to reduce risk. Research. Stay informed about market trends, technological advancements, and regulatory changes. Risk tolerance. Assess your risk tolerance and invest only what you can afford to lose. Getting started with your first crypto investment. 1. Researching and selecting a cryptocurrency. Understand your goals. Before you invest, it's crucial to understand what you aim to achieve. Are you looking for long-term growth, short-term gains, or simply exploring a new market? Research cryptocurrencies. Look into various cryptocurrencies, their use cases, and their underlying technology. Some popular choices include Bitcoin, BTC, the first and most well-known cryptocurrency, often considered digital gold. Ethereum, ETH, known for its smart contract capabilities and decentralized applications, dApps. Stablecoins, cryptocurrencies like Tether, USDT, that are pegged to a stable asset, reducing volatility. Evaluate the team and community. Check the development team's credibility and the community's engagement. A strong, active community and experienced developers are positive signs. Read white papers. A white paper is a comprehensive document outlining a cryptocurrency's purpose, technology, and plans. Reading it can provide valuable insights into the project's potential. 2. Making your first purchase. Choose a reliable exchange. Select a reputable cryptocurrency exchange to buy your chosen cryptocurrency. Popular options include Coinbase and Binance. Set up an account, register on the exchange, complete the identity verification, KYC/AML, and secure your account with a strong password and two-factor authentication. Deposit funds. Deposit fiat currency, e.g., USD, Euro, into your exchange account via bank transfer, credit card, or other supported methods. Place an order. Navigate to the trading section of the exchange and place a buy order for your chosen cryptocurrency. You can choose between market orders, buy at current price, or limit orders, set a specific price. 3. Monitoring your investment and adjusting your portfolio over time. Track your investment. Regularly monitor the performance of your investment using tools and apps like CoinMarketCap or CoinGecko. Stay informed. Keep up with news and developments related to your chosen cryptocurrency and the broader market. This can help you make informed decisions. Portfolio diversification. Consider diversifying your portfolio by investing in multiple cryptocurrencies to spread risk. Rebalance your portfolio. Periodically assess your portfolio and make adjustments based on your investment goals and market conditions. Rebalancing helps maintain your desired asset allocation.